Hi, I'm Jillian. I'm a partner at Johnston, Morrison 100 Chartered Professional Accountants. We have teamed with the Medicine Hat District Chamber of Commerce to provide some information sessions on some of the current government programs available to businesses that have been impacted by the COVID-19 pandemic. So today I'm going to be speaking on the Canada Emergency Wage Subsidy Program, or CEWS, as I'll call it throughout this presentation. So let's just jump straight into it. Okay, so what we're going to be talking about today is basically who can apply for CEWS, what's considered an eligible employee, what about eligible remuneration, what does it mean by having a revenue drop. We're going to talk about claim periods 1 to 4 specifically, as well as claim periods 5 to 10 in some detail. We'll also touch on the T4 reporting requirements, potential audit requests, and how you actually go about applying for this benefit. So in order to apply, you must meet all 3 of the following criteria. You must have a CRA business number, you must be an eligible employer, and you must have experienced a drop in revenue. So for the CRA business number, you must have had one of the following: a CRA payroll account on March 15, 2020, or another person or partnership made payroll remittances on your behalf as of March 15, 2020, or you purchased the business assets of another person who had a CRA business account. As well, you also made an election under the special asset acquisition rules. So we're not going to really talk about the special asset acquisition rules at all, but just know that if you did acquire a company, you can still fall into this CEWS program. If you do not have a business number at the moment, but you did have a third party that was responsible for your payroll, you just need to now establish a payroll account. So you're going to kind of go on to CRA, get the payroll account set up. You will have to talk to somebody just in the sense of confirming that it's a March 15th, but you should still be able to apply for the CEWS program. So what exactly is meant by an eligible employer? So that would be an individual or sole proprietorship, corporation or trust that is not exempt from income tax, registered charities, partnerships that are consisting of eligible employers, prescribed organizations, excluding public institutions, as well as the following people that are exempt from income tax. Just note that this is not a comprehensive or an exhaustive list. So nonprofit organizations, agricultural organizations, as well as Chamber of Commerce, they would all be considered an eligible employer. So for a revenue decline, so in order to qualify, you must have had a drop in revenue when comparing your eligible revenue during the reference period with your eligible revenue from a previous period baseline. So we will talk later about how this is calculated under both claim periods 1 to 4 and 5 to 10, but just know that there has to be some type of drop. So eligible revenue is basically revenue earned in Canada from selling goods, rendering services, and others' use of your resources arising from its ordinary activities in Canada in a particular period. So if you did have something that was an extraordinary event in either one of your periods, just know that those do get excluded. The other thing to note with revenue decline is that revenue is typically calculated on the accrual or the cash method. So you can elect to use either method, but once you choose one method, you have to stay with the same method for all claims. So most businesses are operating on the accrual method anyway. So that's essentially where they're recording sales as the sales are actually earned, rather than when they actually receive the cash in their pocket. As well, if your pay schedule, so the amount that you're paying your employees, doesn't align with the wage subsidy claim period, you are going to have to do some manual calculations to determine how much was paid, how much you paid the employees in respect of each week. So who exactly are your eligible employees? So a person who is employed by you primarily in Canada throughout the claim period. So during claim periods 1 to 4, this would not include any employees who had 14 or more consecutive days unpaid in that period. They did remove the stipulation for periods 5 and above, but just note that in those first 4 periods, you did have to actually be consecutively employed. As well, the employee does not have to live in Canada, but they must be employed in Canada. So generally that does mean physical presence. As well, if you retroactively hire and pay your employees, they would be considered eligible employees, but they must be rehired and paid before they can be included. It is important to note who is an arm's length employee versus a non-arm's length employee, as the subsidy is calculated differently for eligible non-arm's length individuals and arm's length employees. So typically a non-arm's length employee is going to be somebody that's related to you, perhaps a spouse, yourself, child, or parent. Those are all going to be non-arm's length. As well, if, active employees and employees on leave with pay, those are considered eligible employees. Now, for claim periods 5 to 10, employees on leave with pay are treated differently than active employees for the calculation of the subsidy. So it's important that you do differentiate who those employees are. As well, if your employees are participating in a work sharing program, they are also eligible employees. You just need to know the amount of the EI benefits being claimed or be able to complete a reasonable estimate. So eligible remuneration for the purpose of this calculation will generally include salaries, wages, certain taxable benefits, fees, and commissions. Sick pay, vacation pay, or stat holiday pay is also generally considered part of overall remuneration. It would not include tips given directly to the employees, so where the employer does not control it, severance pay, non-cash taxable benefits, or dividends. So your non-cash taxable benefit, that would be where an employee has use of a company vehicle and they end up with a taxable benefit on their tax return, but they don't actually receive any cash in exchange for the use of that vehicle. So in general, when you're calculating whether or not there has been a decline, you're going to do a base revenue drop. And there's two methods to do this. So method number one is considered the general prior reference period. So that's where you compare the month of 2019 and 2020 that relate to a claim period. So for instance, May 2019 to May 2020, or September to September. Method number two is the alternative method. And so what that looks at is that looks at the average of January and February 2020 revenue, and it compares it to the months of 2020 that relate to that claim period. So in general, you're going to choose whatever method works the best for your business. So if you weren't in full operations in 2019, that alternative method might make more sense, as you'll end up with a bigger revenue drop than if you look at perhaps the May to the May. The one thing to note though, is that once you choose a method, you have to stick with it. The only exception to that is that you can switch to the other method once you go into period 5. So periods 1 to 4 have to be the same method, and then 5 onwards needs to be used the same method. So let's talk a little bit about claim periods 1 to 4. So claim periods 1 to 4 was essentially at the very start of the program. And so they made it very simple for businesses wanting to apply. The subsidy is going to be equal to 75% of the eligible remuneration you pay. Now note that CEWS accepts rates up to 2 decimal points. You cannot round up to reach a threshold. So what that means is if you have a 29.99% revenue drop, that does not equal 30%. And this is going to become important. So here's a little summary. So claim periods 1 to 4 is from March 15th essentially to July 4th, 2020. So you can see period 1 goes from March 15th to April 11th, period 2, April 12th to May 9th, period 3, May 10th to June 6th, and then period 4, June 7th to July 4th. So the deadline for applying for all these periods is going to be January 31st, 2021. But you'll also notice that the drop in revenue does differ between the periods. So for period 1, you only needed to experience a drop of 15% or greater. For period 2 onwards, you had to experience a 30% or greater revenue drop. So if you do choose the alternative method that we previously spoke on, that January to February comparison, you would check the prior reference period election box when completing the application. So what they have provided, though, to make it a little bit easier, is they've done what's called the Deeming rule for claim periods 1 to 4. And so essentially what that means is that for periods 1, 2, and 3, if you determine that you qualify for one claim period, you're automatically going to qualify for the next claim period. So for example, if in claim period 2, you had a revenue decline of 32%, you are automatically into that claim period 3, even if you don't have that 30% decline. As previously mentioned, once you do choose a baseline method for how you're calculating your revenue drop, you need to remain with that method for the remainder of claim periods 1 to 4. So this is where if you haven't done it yet, you do kind of want to test to see which one works better for you. Is it the March to March, or is it the March 2020 to January, February 2020? This is the general way that the calculation of the subsidy works. We won't talk about it, but just so you can kind of see the slide, you're essentially looking at potentially 75% of the eligible remuneration or a different number. If you have claimed the 10% temporary wage subsidy, that is going to be taken out of it. There's a separate information session on that temporary wage subsidy, so be sure to review that if you think you might have already claimed it. So what about claim periods 5 to 10? So they finally put some thought into this program and they decided to change it up a little bit. So with claim periods 5 to 10, there is no minimum revenue drop that is required. Any revenue drop is a good revenue drop and will get you into CEWS for these periods. So here's again a little summary sheet of 5 to 10. So period 5 is July 5th to August 1st. We can see period 10 ends up at November 22nd to December 19th. Again, all of these periods 5 to 10 are currently open. And you'll see the deadline dates are from January 31st, 2021, all the way to June 17th, 2021. So the deadline is generally January 31st or 180 days after the claim period ended, whichever is later. So we're going to talk a little bit about the change to the baseline revenue under claim periods 5 and onwards. So starting with period 5, you actually end up calculating 2 revenue drops and you use the higher result for your base calculation. So this is if you're using that July or June and so forth. So you do a current period drop and the previous period drop. So for example, claim period 5, you're going to use the higher revenue drop for July 2020 over July 2019 or June 2020 over June 2019. Now, if you've decided that you want to use that alternative method, you're going to be looking at the higher revenue drop for July 2020 over January to February 2020 or June 2020 over January and February 2020. So you still get 2 options. It's just depending on which method you're utilizing. So the overall calculation for claims period 5 and onwards looks at a base rate plus potentially a top-up rate. So the base rate for CEWS claim periods does kind of diminish as you go along the claim periods. So what that means is claim periods 5 and 6, if you have a revenue drop of 50% or more, it's going to be 60%. If your revenue drop is less than 50%, it's going to be 1.2 times the revenue drop. So period 7, if you've got a drop of more than 50%, it decreases to a 50% amount for the base. And again, if it has a drop of less than 50%, it decreases to 1 times the revenue drop. So for instance, you have a 40% revenue drop, you end up with a 40% base rate. Periods 8 to 10, again, decreases to 40% or 0.8 times the revenue drop if you're less than a 50% decline. If you end up with a decline of 50% or more, you get the top up. So that applies to any eligible employers whose revenue basically has dropped more than 50% in a claim period. Just because they like to make it complicated, the top-up rate calculation differs for the periods. So claim periods 5 to 7, for period 5, you're looking at a 3-month average of April, May, June 2020 over April, May, June 2019. Or if you've used the alternative method, you're looking at April, May, June 2020 over January and February 2020. Again, you need to use the same method that you use to calculate your base amount. So you're either using the general prior reference period or that alternative prior reference period. And period 8, they decide, let's give you quite a bit of options. So you've either got, you're looking at October over October, or October over January and February. And for the Safe Harbor version, you're looking at July, August, September, again over July, August, September. So what does that actually all mean at the end of the day? So basically the top-up rate calculation for claim periods 5 to 10, if you're over 70% or higher, you're going to end up with a 25% top-up. If you're 50.01% to 69.99%, you're going to be looking at a top-up of 1.25 times your revenue drop minus 50%. And if you're 50% or lower, you don't qualify at all for the top-up. So the other complication or wrench in these claim periods is that for periods 5 and 6, they have what's considered the safe harbor calculation. So essentially what that is if your base revenue dropped at least 30%, but you're not receiving a subsidy rate of 75%, you could use the rules and calculations from period 4 to calculate your subsidy amount. This is the general calculation for the subsidy for an active employee. It is slightly different for a non-active employee. We're not really going to go over it in any detail, but you can definitely just see here how it kind of has modified and changed a little bit. There's also going to be claim periods 11 to 16, and those are going to go from December 20th to June 5th. So periods could slightly change a little bit still, but the important thing to note is that essentially when a claim period ends, the next day applications will be open. And again, keep in mind that 180-day deadline date. If you've listened to our rent subsidy one, our CEWS program, you'll also note that basically these claim periods will line up with the CEWS program. And you've got to maintain the same revenue decline or the same revenue method for both the CEWS program, so the wage subsidy, and the rent subsidy program. So T4s are going to look a little different this year for the 2020 year end. So there are additional reporting requirements that are going to apply to all employers. So even if you haven't claimed the wage subsidy, you're still going to need to do these reporting requirements. So essentially what's going to happen is the employment income from the following periods must be reported separately, in addition to being reported on box 14, which is your employment income. So codes 57 to 60 have now been created, and it's going to capture the employment income, that you have paid from March 15th to September 26th. And so really the idea behind this is they're trying to determine whether individuals have been claiming the Canada Emergency Response Benefit, or CERB, on an individual level while they were also receiving payment from a job. So the T4 reporting is going to be based on payment date, not when you actually earned the income. The other important thing to note about these CEWS claims is that CRA is contacting the filer sometimes within an hour of the return being filed. Often they'll also follow up with an audit letter that is sent via mail or through an online portal if you're registered for online mail. So that would be in your My Business account. They're considering it a limited scope audit. The following slides are kind of going to show you a sample letter, and they're asking for a lot of information. So don't be too overly concerned, I suppose. If you do receive a letter, just know that a lot of businesses that are claiming CEWS are going to receive this letter. So you can kind of see they're asking for various information from the minute books, agreements with respect to any employee loans or shareholders registries, anything perhaps with the corporate group, if there is any other corporations involved. It's going to also want to know how you actually did calculations, perhaps some bank statements, proof of payment to employees. And it goes on and on and on. So like I said, if you do receive it, try not to get too panicked. If you do have an accountant, they'll help you with the majority of it. So how exactly do you apply for this? So you can apply through your My Business account, through Represent a Client, or if you don't have either of those, you can use Web Forms application using your web access code. So CEWS, there's a lot of information in CEWS, and there's definitely more information and more nuances that perhaps haven't been covered in this session. So if you do have any questions, please don't hesitate to contact us. You can phone me directly at 403-905-2181 or email jkoch@jmhca.com. You can also call the office 403-527-4451, and any partner or associate will be happy to help you. As I mentioned, there's definitely a lot of nuances involved with the CEWS program. So if there are any kind of frequently asked questions that we're receiving, we'll do another information session and cover those and hopefully provide you with some more information on how this program actually works. Thank you so much.